Today I'm going to focus on the news coming out of the G20 Summit yesterday. First, for those who don't know, there are actually two different G20s. One of them is the Group of 20 Developing Economies, which only includes economies from the developing world. The other is the Group of 20 Major Economies, which includes a mix of developed and large developing economies. The meeting in London was for the 20 major economies. So what came out of it? I'll go point by point through the major issues. If you want to, you can always check the G20 website at g20.org and read the full reports. Now first, the G20 agreed to triple the resources given to the IMF. This goes from $250 billion now up to $750 billion. The IMF uses this money to help economies that are having severe financial problems. Typically these would be developing countries that are having trouble paying back loans to other countries. Okay. And normally, as part of this emergency loan process, these countries are required to undertake certain macroeconomic reforms to fix these debt problems. Now, seeing as it's becoming far more likely that countries are going to run into these kinds of problems in the very near future, the G20 decided increasing the amount of funds available would be a good idea. Now, is this actually a good or a bad thing? Well, on the one hand, it creates something of a moral hazard. That is, if a country knows that there's help available, it's far more likely to undertake risky activities and then just take advantage of the help, since it knows it's going to be there. So as far as increased loans do that, it's going to be a bad thing. However, this money that the IMF loans out are loans. And if they get paid back, then it doesn't create any moral hazard at all. After all, if you take these losses, you get a loan, you pay for the losses, and then you pay the loan back, really you've paid the losses. Now the problem is, with these IMF loans, often they don't get paid back. Right now, there are about $2 trillion worth of IMF loans that are more than 6 months overdue. So, in all likelihood, we will see a significant moral hazard coming from this increase in IMF loan activity. Now second, the G20 agreed to support the creation of $250 billion worth of new SDRs. SDRs are special drawing rights. Now, in a way, they're sort of an IMF-issued money that is convertible into a basket of currencies. It's a mixture of the dollar, euro, yen, and pound. Now, you can use SDRs to pay for any IMF obligations. If you borrowed all of this money in emergency loans, you can pay it back in SDRs. And occasionally, central banks will use SDRs as reserves. That's right. Occasionally, banks will use SDRs as a reserve. So, effectively, by creating these new SDRs, the G20 has decided to print a bunch of reserve currency that central banks can then use to inflate their own currencies. The result's really rather simple. More money gets created, so prices go up. Now often, at least at first, you're going to get a boom in output as well. So, at first, we have this monetary inflation, we'll get a boom in output, and then prices will follow. But when prices follow, the boom in output comes right back down. Now third, the G20 agreed to support an additional $100 billion of lending by multilateral lending banks. We think of something like the World Bank. Now generally this lending is given to developing countries for development projects. We think of things like roads, bridges, schools, that kind of thing. Now fourth, the G20 agreed to ensure $250 billion of financing for international trade. This is actually a significant point of concern right now. From July of last year to January of this year, imports into the United States fell by about 30%. Exports from the United States fell by about 25%. And this experience is not unusual. Many countries are experiencing exactly the same thing. Countries all around the world are exporting and importing less, and many are becoming far more protectionist, despite nice words that they might spout at a G20 meeting. Now the hope, however, is that by providing finance for international trade, all this tightening that we talk about in the credit markets, we're hoping that won't have an impact on trade by providing this financing specifically for trade. Now fifth, the G20 agreed to have the IMF sell some of its gold reserves and then use that money for concessionary loans Now those are loans at a below market rate of interest for the poorest countries, also generally for development sort of issues. Now all told, this is going to be about $1.1 trillion that's going towards supporting the international trade system, if we want to frame it that way. Now, what remains to be seen is whether these steps will actually work, and even how we might evaluate whether they did or not. It's actually pretty likely that some of the measures are going to create a boost in worldwide economic activity. More resources for the IMF should help keep things from looking too bad in the developing world, and the introduction of new SDRs will provide a monetary boost on top of that. However, both of these boosts are likely to be short-lived. We'll see in the developing world excessive risk-taking with IMF money. That's going to lead to more losses in the pretty near future, and eventually this monetary boost is going to transfer from output to prices, and all we'll have is inflation. Now it's perfectly possible, though, that this boost that we do get, this temporary one, might not actually materialize at all, or that it's going to be totally overwhelmed by the very real problems facing the world economy. Now, the last step that I want to talk about. The G20 agreed to give the IMF kind of vague, not very specific, financial watchdog powers. Now, let me read from their communique. They say, "We each agree to ensure our domestic regulatory systems are strong, but we also agree to establish the much greater consistency and systematic cooperation between countries in the framework of internationally agreed high standards that a global financial system requires. Strengthened regulation and supervision must promote propriety, integrity, and transparency, guard against risk across the financial system, dampen rather than amplify the financial and economic cycle, reduce reliance on inappropriately risky sources of financing, and discourage excessive risk-taking. Regulators and supervisors must protect consumers and investors, support market discipline, avoid adverse impacts on other countries, reduce the scope for regulatory arbitrage, support competition and dynamism, and keep pace with innovation in the marketplace." End quote. Now, the odd thing to me is that they're blatantly ignoring the root of the problem. Inflationary central banking in a fractional reserve banking system combined with implicit or explicit bailout guarantees. Central banks provide additional credit. This artificially pushes down interest rates. When we have all of these bailout guarantees in place, all this cheap credit gets poured into very risky investments. After all, it's a heads I win, tails the taxpayers lose scenario. Many of these risky investments are going to end up failing. They are, after all, risky, so the banks can't get their money back. Since the banks have fractional reserves, this is a serious problem, because now they don't have enough money to pay all their depositors. And you end up where we are today. Right now, the banks are holding on desperately to their toxic assets because, as long as they do, they can hold out hope that they will someday turn good, or that the government will buy them at totally unjustifiable prices. Now, there are lots of ways we could solve the problem. First, we could eliminate inflationary central banking. That would have eliminated this artificial supply of cheap credit that got the ball rolling. Second, we could eliminate fractional reserve banking, which would have eliminated all of these solvency problems. We wouldn't be worried about banks going under if they were 100% reserve. Third, we could eliminate the promised bailouts, which would eliminate the incentive for all of this risk-taking. Of course, that's not what the G20 is actually asking for. Instead, it's asking for oversight. So, rather than eliminating the incentives for risk-taking, or the source of funds for risk-taking, or the institutions that make risk-taking a problem, we're going to create an institution that says, hey, that's risky, you probably shouldn't do that, and slaps banks on the wrist. It's like handing a child ice cream, and then telling them not to eat it. Of course you can do it, it might even work, but if you really want to keep the kid from eating ice cream, then an easier plan is to not give them any. So, on the whole, I'm skeptical of this G20 meeting. I think the best things, being these nice words we hear about free trade, are likely to be pure lip service. The really substantive things that are happening, which is what I've talked about here, are likely to have very few good long-run effects, which is pretty much what I've come to expect from politicians.